Hey guys, my name is Bob Iacino. I'm here with Jim Iorio, as always, doing the Tradier rundown. Jim and I are the hosts of Tradier's Trader's Edge, the wildly popular, funny, and once in a while informative financial show that we have 4 p.m. Eastern Time, live on Wednesdays, 3 p.m. Chicago time, Jim. Not going to leave that out. But the rundown this week, Jim, we're talking about interest rates. And I wanted to lead it off because it is sort of your specialty. And something that I find really interesting is that for quite a while, you've been talking to anyone who will listen, including myself. I don't always listen, as to the shift in what the Treasury is doing with their issuance, how they're issuing shorter term bills, and those sort of act more like cash or almost like QE. So how do you think that's affecting what we saw with rates, specifically today with the flattening or flattening leading to steepening that happened today?
I'm long a steepener. And so I think what's reflected today in the steepener and for the last couple of weeks is the growing notion that the Fed is going to cut perhaps, and that's a small perhaps, as soon as the July meeting, which is next week. I don't think that's going to happen, but I did see a ton of trades go through in SOFR options today with people positioning themselves in case that happens. Now it's essentially 100% a September ease to like 65 basis points of easing this year, and then 165 basis points between now and September of next year. So that I think is the biggest move of the steepener. But something you mentioned, I think is tremendously important. For the last, let's call it a year, the U.S. Treasury knows that they're huge profligate spenders, right? So they've been concentrating and selling a crap ton. That's a technical financial term. A crap ton of 3-month bills out to maybe even as far as 2 year, but mostly just 3 month to satisfy their borrowing needs. Now that money is running out because they were taking advantage of money that was left in the reverse repo. They were also taking advantage of money that was in the Treasury General Account, which is the Treasury's account that they hold at the Fed. They've taken $200 billion out of that and injected it into the market. Is it political to keep things humming along prior to an election? Yes, it's political to do that. That's why they're doing it.
You didn't wait that long to make that point. So
yes, it's political. So now in the year to come, they have to issue more long end debt because the demand on the short end is not going to be as reliable as it was. They know they're going to do that. About half of the long end auctions that have gone over the last 6 months have been weaker than expected. Half have not been, by the way, too. So still just a mixed bag. But I do think that rates are going to come down on the short end. I think the economy is not as strong as they say it is, and inflation is subsiding. Now we got that PCE number on Friday. I'm sorry I'm talking so long, Bobby. But then the long end rates could go higher, in my opinion, by the sheer weight of volume of the issuance that needs to happen. That's why I initiated the steepener. And by the way, everyone's saying, yeah, you say you had a steepener on. I've been saying it the whole time. I put it on at about -50, took it off at -30, put it back on at -30 again. And I'm riding the steepener out. I think the yield curve is going positive within the next quarter.
Yeah, you can actually go back and watch recordings of really any of our shows to see Jimmy talk about both of these things. And so I wanted to ask you, we had that weaker CPI. You mentioned we got PCI coming on Friday, but we had hotter PPI. Does that bother you at all? Or are you looking at more of a broader picture of data?
No, it does bother me. It's not just one PPI that was higher than expected. It's been the last 2 that have been higher than expected.
Right.
They have been the outlier, though. And I think you got to balance it. CPI, PCE, all the price components of the different ISMs, all those are pointing one thing, but the PPI is pointing the other direction. Now, it is a tier 2 inflation data, in my opinion, because it doesn't figure in as much of the stuff that CPI does. And CPI, by the way, you can argue is a bullshit indicator too, but it's a bullshit indicator that the market tends to look at. And now PCE is taking that spot as well too. So the PPI thing is interesting. And that's why I need to see Friday. This PCE number is going to be a big deal. And by the way, if it comes in significantly higher than expected, kiss goodbye that rotation from big tech into small cap, because the small cap trade is dependent on the belief that short end rates are going lower. So I think they are. I think they are going lower, but that PCE number is the bear trap.
Yeah, PPI has to feed down to the consumer, right? And that isn't always the case. We saw that for years where PPI was strong and it didn't reflect in CPI at all. So last question I had for you. It's pretty certain that the Fed's going to cut rates. Our job is to figure out what the market's going to do when they do this. My question to you, do you think they should, and are interest rates reflecting it properly?
So do I think they should? I think it's immaterial. I think the difference between a 5.25 to 5.5 Fed funds rate is the same as a 5 to 5.25. If I got those numbers by a quarter off, I don't think I did. No,
you're right.
Essentially the same. So in the chairman's mind, he believes that we are above the neutral rate. So he thinks that rates will still be restrictive if he even cuts 1, 2, maybe even 3 times. So he doesn't think he's necessarily taking rates to easier as far as under neutrality. He just believes he's bringing them back to neutral. So whether or not I think he should, I guess what I'm saying is I don't think it really matters for the first ones. It doesn't matter till he's cutting because he's panicking, and those won't be 25 basis point cuts.
Yeah, it's funny if the Fed keeps or the Treasury keeps issuing on the short end, they're kind of cutting. They're kind of adding cash to the system in short-dated instruments. Make sure you guys tune in to the Trader's Edge. Again, that's a live show. It's not taped. It's a live show. It's every Wednesday, 4 p.m. Eastern Time, 3 p.m. Central Time with Jim and I, and usually a guest. We got a good one this week. Unfortunately, you're seeing this later, so you'll have to watch the replay. But check us out. This has been Trader's Edge and the Rundown.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.